Principles of Microeconomics, Chapter 16, Information Risk and Insurance, Professor Wagner. The problems of imperfect information, asymmetric information, insurance, and imperfect information. The Affordable Care Act has been, still is, a controversial topic, but it does relate to the topic of this chapter. Once again, there were many flaws and poor assumptions made on the basis of faulty information. So imperfect information definitely played a role in how this was to be implemented, how this was to be disseminated to the public via online resources. Was originally a disaster in the very beginning. The Congress people, the Senate, didn't bother to read the document to see what was actually inside. Instead, they voted on it. So this was really a poor example of policy. And so, but it does have something to do with health insurance and making it available to people who wouldn't otherwise have health insurance available to them. But many of the desired results and outcomes and expectations were just simply not met. The problem that really with ACA or any other form of legislation is that there's asymmetric information where there's a situation where a seller or a buyer has more information than the other regarding the quality of the item for sale. Imperfect information is where the buyer and seller both are uncertain about the qualities of what they are buying and selling. Both of these most certainly applied in the ACA example. Imperfect information can affect equilibrium, price, and quantity. The presence of it can discourage both buyers and sellers from even buying. Buyers become reluctant because they cannot determine what the quality of the product is. Sellers of high quality and medium quality goods may be reluctant to participate because it may be difficult to demonstrate why their product's better. And so buyers are unwilling to pay a higher price for goods that may be considered generic. And also, this is particularly true in where there's very few buyers, very few sellers in a thin market. Price mixes with imperfect information about quality. And so a buyer could be confronted with imperfect information, often believe the price reveals something about the product's quality. That's all the more true. Somebody will automatically assume the Lexus is a much better car than the Toyota, even though they're built on very similar frames and platforms, and even the power plants are pretty much identical. They're paying for the perceived notion of higher quality because of the extra features that the Lexus product has. When buyers use market price to draw inferences about a product's quality, the markets may have trouble reaching an equilibrium price of quantity in the meantime. The idea that higher prices cause a higher quantity demand and lower prices might cause a lower quantity demand actually runs counter to the basic model of demand and supply. So what are examples where price level may not correlate with quality? Okay, we could also take maybe jeans as an example. So let's say Levi's has been kind of a standard for about a century and a half. They still make a good product. The perception of that product being of good quality has endured for really an incredibly long period of time. And then you have, let's say, competitors like Lee or Wrangler. And so Wranglers, they might appeal to the cowboy type or the ranching type. So more so than the Levi's. Levi's, especially internationally, symbolize certain quality. It's like wearing Ralph Lauren in the States, so to speak. So it's really whether the product's actually better or not can be debatable, but it is public perception. There are mechanisms to reduce risk of imperfect information. So good markets will rely on reputation, so that's a goodwill, and in the accounting world: guarantees, warranties, and service contracts to assure product quality. Labor market uses occupational license and certifications. That's been kind of the big buzz, right now, particularly in the IT industry. Financial capital market uses cosigners and collateral as insurance against unforeseen detrimental events. And so it's just a question of, what's being presented. A good example of this would be, let's say, the Kia automobiles. When they first came over to the States, they were low quality. It was obviously they were low quality. And they meant to appeal to an audience that couldn't afford, let's say, a better quality car. They were cheap, they were effective. And then in order to gain more confidence in the product for the public, they started with a 10-year, 100,000-mile warranty. And so now they are a very prolific car in the U.S. auto market right now. So, the guarantee certainly has done a lot to their street cred, so to speak. So money-back guarantees, warranties, and service contracts, are all things that people can use as hedges against the risk of imperfect information. And so these are frequently offered by most people selling durable goods. Occupational licenses, cosigner collateral, these are all, gestures of goodwill or an establishment that a certain skill level has been met, by a license. These are all things that employers or capital firms will use to ensure, that the imperfect information being given to them as part of underwriting is somewhat hedged against. Insurance is protecting people from a financial loss. Policymakers make regular payments to the insurance company. The firm reimburses a group who suffers a significant damage from an event covered. Premiums are regular payments made to by households or firms to the company. What people don't really understand about insurance very typically is that insurance is, in fact, a risk pool, and the risk pool is, let's say, thousands of clients, and they all, let's say, have a need for auto insurance, for instance. Now, out of that 1,000 clients, there'll be different driving, types, driving records, habits, and so there'll be a certain claim incidence against that pool, and they can pretty much, actuaries can almost on the large scale count the T just exactly how much money they're going to lose. And so they will adjust the premiums to cover that, their cost, expenses, and whatever margin they want to, get above and beyond that. So if, let's say, lightning doesn't quite strike in the same manner that the actuaries have foretold, and the insurance company had a relatively low claim year, well, then they will have made a bigger profit. Sometimes it gets passed on to the consumer, sometimes it doesn't. Currently, it's being passed on to the consumer by most auto insurance companies because people simply aren't driving anywhere near the way they used to before the COVID crisis. And so insurance markets, and these are some of the insurance policies I've talked about. There's all manners of insurance, and who pays for it and what type of claim is being serviced. It could be a table that could be seen on its head. Insurance works because you have premiums, coming in from the customers, and then of course some of that money is invested in monetary instruments to try and gain some type of capital gain or interest or dividend on the money while it's outstanding, and that's the reserves. And the money out is payments to customers, expenses, profits, and losses. So this is, money in, money going out, and whatever this is going to be more than what comes out of here, more than likely. Federal and state governments run a number of insurance programs. They look like private insurance, and they're designed to protect against risks such as unemployment insurance, pension insurance. So there's, if you have a defined benefit pension, which is increasingly rare these days. But should you be one of those lucky people that gets a defined benefit pension, there's a guaranteed corporation to make sure that the pension doesn't go in default right at the time you're ready to retire and collect on your years of service that you put in. Teachers or city employees, federal employees, there's a number of people still get these. Workman's comp is when you get hurt on the job, so you want to go ahead and cover the employee for any kind of fluke accident that may happen on the job site, where you're able to compensate the employee and uh, try to make the employee whole again, at least financially. So there's an insurance for that. Then there's the Social Security and Medicare insurance, which is basically a social compact for those workers that are retiring and are no longer a part of the workforce. Medicare ensures that health care is available to older clientele who typically will have more health problems in their older age. Risk groups and actuarial fairness. Not everybody who purchases it face the same risk. There is a risk group, and so basically it'll have, let's say teenage drivers might be considered a risk group. They're more inclined to get into accidents. They're more inclined to take unnecessary risks of claims and the cost of covering them for insurance purposes. Car insurance is generally much higher than it would be for somebody, let's say, that's 35 and maybe is, you know, has a family, married, home, different types of behavior in both groups. Insurance company will classify them and charge lower premiums for those with lower risk. If people are not separated to risk groups, then those with low risk groups must pay for those with high risk groups. So that could be a real parity issue with regards to health insurance, and the current system pretty much does lump everybody in the same risk pool. And so instead of the ACA reducing actual cost for health insurance, they've skyrocketed because the higher risk groups have been forced into the risk pool along with, let's say, healthier, less risky patients. A common problem with insurance is that uh, moral hazard. So when people have insurance against that event, they're less likely to guard against that event occurring. And so imperfect information is the cause of moral hazard. So if somebody knows something the other party doesn't, investigations to prevent insurance fraud is a way of reducing extreme cases of it. Insurance companies also monitor certain kinds of behavior. So there are people with behavior patterns that, would cause them to be more likely or more prone to commit, fraudulent acts, arson to collect, let's say, on a failing business, that type of thing. Or, gee, my car's a lemon and I took my boat out to the dock and I didn't put the emergency brake on, and well, the truck just went into the lake, it's ruined. So there's, all kinds of things people will do to try to game the system, and that's what moral hazard consists of. Insurance cost sharing. So there's deductibles, co-payments, and co-insurance. These require the injured party to pay some kind of share of the cost. And so usually if, let's say an insured has skin in the game in terms of a certain dollar amount that they'll have to part with, the rinky-dink small claims will probably get ignored. They'll find another way to deal with that very often. And so the larger the deductibles or co-payments or co-insurance becomes, in terms of the portion of what an insured would pay for a claim, the less likely insureds will file claims unless there's something, of significance happening. Healthcare provider incentives. So, there's ways for people to, you know, be incented to adopt healthier lifestyles. And so one is fee for service. So older way of insurance, newer way of health maintenance. So basically that's what they do is they do a physician pool of a select group of physicians that agree contractually to work with this insurance provider. for, let's say, set rate fees for the types of services that they do provide. The advantage to the physician is that, a certain, select group, they don't have to go fishing for clientele so much. The marketing aspect is somewhat handled, but the downside is they can't charge more than the agreed upon price to the patient in most instances. Provider incentives. Okay, patient with insurance has more incentive to demand care. If the healthcare provider, which is on, so if a doctor or physician is not really receiving what he might consider a fair, a fair remuneration to for the care provided, there will be an incentive to reduce the moral hazard problem by limiting the quality of care offered. There is a problem. Sometimes doctors won't take Medicare patients, for instance, because it's fraught with fraud, it's low paying, and doctors sometimes aren't able to meet costs. Doctors are doctors. Very often they're not business people, and very often they hire professional business people to help them manage their practice. So these will be reasons why providers would be incented to duck, certain types of claims. Adverse selection is another problem. Higher risk groups, when they seek out insurance, they tend to strain the insurance system. So they tend to want to buy more insurance. They'll let the company know about their higher risk. So basically, they'll just lie about their application. Harder to do with, let's say, auto insurance because of the public records that are kept for all drivers in most states. But other insurances, such as life insurance and whatnot, people may decide to not tell the insurance company about their diabetes or their heart problem. And most life insurance policies will say, we will not pay the face amount for the first 2 years should it be discovered that you lied on your application. But then most of them, well, after the 2 year period, would even pay, for a suicide after 2 years. So some people might take advantage of this. U.S. healthcare in the international context, we're the only country in the world where private firms pay and provide most of the health insurance. Uh, Greater government involvement is a way to reduce the moral hazard and adverse selection problems. Certainly, the adverse selection problems were addressed with the ACA and a wider cross section of the population have insurance available to them because of the lack of having to report pre-existing conditions and the like. And many studies have shown a country's health is more closely related to diet, exercise, and genetic factors than to healthcare expenditure. So, it's true if you get your Jones in for the Burger King and you feel the desire to eat 3 Whoppers a day and sit around on the couch and eat chips at night with, full on sugar Coke, there's a good chance that your genetics, even if you have good genetics, you're going to get unhealthy over a period of time. So that's an extreme example. Or people just take unnecessary risks. In other areas, there's many contributing factors to this. Then there's government regulation of insurance. Mostly, this is happening within the state. So the state of Texas has a state board of insurance, and so they want to do two things: keep the price of insurance low, ensure everybody has insurance. Sometimes people debate whether the state is really trying to keep the rates low because there are lobbyists who petition for, let's say, certain costs or certain profit margins that they want to maintain. So they will try to talk the state into saying this is the rate we think that would be fair, and these are the discounts we'll give against that rate. So that's why your car insurance and your homeowner insurance tends to creep up on an annual basis. That's the actual cause. government regulation of insurance. People in high risk groups may get, such a high premium presented to them, they would probably just blow off buying insurance at all because it's just simply unaffordable. They can't force people to charge low prices and provide high level insurance for a coverage of time. Insurance premiums are set below the actuarially fair level for a certain group, while some other group will have to make up the difference. So, the notion of no fault insurance, which happens in some states, it means that everybody's dumped into the risk pool. And so those rates tend to be, a little bit higher, certainly, than a actuarially divided subgroup way of rating people for the cost of insurance. And so uh, cost to the average consumer is just simply higher. Other groups that can make a difference in premium risk, that's taxpayers and other insurance buyers. In some industry, the government decided that it will not provide insurance at an affordable price, so the government pays for it directly, and so that comes through Medicaid or Medicare for those two groups, and then it's require everybody to buy certain kinds of insurance. So homeowners and car insurance are a couple of the mandatory insurance policies. Uh, Mandatory health insurance turned out to be a great big failure because they were trying to entice younger people to become part of the risk pool to help defray the cost of insurance for the older, more claim prone patients. And so somebody that's in their 20s will feel somewhat indestructible and say, nothing's going to happen to me. I'll take the risk and I'll pay the fine and not bother to get any health insurance because paying the fine is way cheaper than buying the insurance. It's an unfortunate thought train, but it was one prevalent during the initial stages of ACA. Patient protection and the Affordable Care Act. We've been talking about this in this particular chapter quite a bit. And so there's an individual mandate, employer mandate, and in the health insurance exchanges. Now, the exchanges were probably the biggest failure in this particular, act of legislation, in the sense that some states only had one provider in that so-called exchange, and they had one price, simply because the state didn't want to have, let's say, or could not afford to have multiple choices. This ends chapter 16.